Good evening, everyone. Speaker of the day, Mr. T.P. Oswal, Co-Chairman of the International Taxation Committee, Mr. Mayur Nayak, my colleague on the dais, Divya Jokhakar, respected Shri N.C. Hegde, all those who have just logged in and watching this telecast live, seniors, ladies and gentlemen. Before we start this lecture meeting, I have a very pleasant task to perform. We are releasing our latest publication on section 197, and it is a very comprehensive publication. And 195, sorry, 195, a very comprehensive publication, and we have the authors also present here. I will request the co-chairman Mayur Naik to tell us more about the book and then the release function. Thank you.
President Chetan Shah, Mr. Ostwal, seniors and friends. Section 195 is always an interesting subject for all those who are practicing international taxation and also those who are in the routine practice, because time and again we are asked by our clients to issue certificates under 195. Issuance of certificate under 195, in my opinion, requires a lot of studies, knowledge, because essentially what we are doing is computing income of the non-residents. But only when the income is taxable, the tax is deductible. So first of all, we need to compute the income in the hands of the non-resident, and for that we need to have knowledge about the international taxation, the domestic tax provisions, the tax treaties, and a lot of other requirements. But that's not enough. Once having computed the income, that when we arrive at the tax deduction at source, the rate of tax and everything, another question comes, how to pay, how to file, because of the e-filing 15CA, 15CB. A lot of procedure is involved in this, and that's where the committee felt that why don't we have a handbook for the practicing chartered accountant, which will guide them step by step in what circumstances the forms are required to be filled, on what circumstances the tax is required to be deducted or not to be deducted, and so on. And I'm happy that Mr. Hegde and his team, Malika Apte and Disha Gandhi, they have come up with a beautiful publication which not only covers the procedural aspect of the tax deduction at source under 195, but they also cover the relevant case laws under different heads of payments. So if, for example, someone were to make a payment for the fees for technical services, then what are the case laws which are available for the make available concept, which is there in UK and the US treaty, etc. Likewise, there are case laws on various aspects: royalties, business profits, permanent establishments, and the entire procedure is explained by way of process flows, the charts, and different heads of income. So in my opinion, this publication would be very helpful to all the practicing chartered accountant whosoever wants to issue certificate under section 195. So with this brief introduction about the book, may I request our learned speaker for the day, Mr. Ostwal, to release this publication, and then to present the first copies to the authors present here. Yeah. आप लोग आ जाइए। Yeah, please come. For the group photograph. Please come.
So now we have got a publication which should be there on every practicing chartered accountant's table. Uh, Coming to the lecture meeting, I welcome you all to this lecture meeting on global developments in international taxation impacting India. Sometimes, when a filmmaker thinks of making a movie, the star cast is decided first, and then the story gets scripted around it. It is always so with our star faculty, whom we rope in first as per his convenient date and time, and from his which is extremely he is extremely busy. And believe me, the topic automatically unfolds once we interact with him for the subject of relevance to we professionals at large. Friends, one has not seen such frantic activity on tax front globally as we are witnessing in the last few years. It is a known fact that the multinational enterprises efficiently exploit the gaps which are there on account of interplay of varying tax systems worldwide to artificially reduce taxable income or shift profits to low tax jurisdictions in which little or no economic activity is performed. Till the US was not hit by the subprime mortgage crisis in 2008, which led to the Great Recession throughout the world, not much was done by many countries to protect their tax base. In fact, these were so dominant that they dictated the terms to their respective governments and tax avoidance was rampant. But scenario has undergone a tremendous change. We have the G20 pushing the OECD to come out with the BEPS action plan. The HSBC scam, followed by the Panama Papers, highlighted how the strong and powerful were using the tax havens to hide their wealth and deprive the country of its legitimate tax dues, creating more imbalance in their already reeling economy. This led to many countries agreeing to enter the exchange of information now on almost automatic basis. In fact, a book has just been released by an IRS officer, Mr. Raghu Navin, on Mr. Rahul Navin on information exchange and tax transparency, who is having a hands-on experience and was working with the FT and TR division of the Government of India, which gives an insight to this world of information exchange, how the government is now getting all the information from across the world. India has been very vociferous in the G20 to push the reforms. It has been propagating to amend the famous India Mauritius tax treaty for quite some time, but nothing much had happened. But now India has been able to show the world that now who is the boss. It has literally forced countries to fall in line. Now we have amended the tax treaties with Mauritius, Singapore, Cyprus. Exchange of information agreement has been signed with many countries, and there is a flooding of information with Indian authorities. Suddenly, there just seems to be no hiding place, and it will be better for the tax dodgers to fall in line to stop the unethical practices. It will be also necessary for consultants to stop advocating tax avoidance structures or else will be heavily punished if found guilty. So, what is the exact scenario on the various tax developments globally? How it will impact India? Is it a fact that now it is India who has started impacting the world with its tax protection measures? Will multilateral treaties make the tax treaties redundant? Is BEPS an answer to tax planning? For all these and many questions to get answered, we have with us one of our best faculties in international tax, Mr. T.P. Ostwal. Please welcome him with a very loud applause. Let me introduce you, sir, first. I know introduction is Mr. Oswal, a rank holder CA and is a partner with TP Oswal and Associates. He has been the first vice president of the executive committee of the IFA Netherlands and the chairman of the IFA India. He is a member of the subcommittee on transfer pricing for developing countries by the United Nations since 2012, which developed the first United Nations transfer pricing guidelines. He has been a member of several committees set up by the Indian government, Indian Ministry of Finance, the CBDT, OECD, and other associations. He is a visiting professor of the Vienna University, Austria, for teaching international tax for the LLM studies. He regularly contributes papers at national and international conferences on a variety of subjects. The IFA 2014 Mumbai Congress was held where he had co-chaired the event. He has been adjudged as the 11th in the top 50 professional in the world for the year 2006-7 by the Tax Business Magazine of UK in November 2006. His firm, Messrs. TP Oswal and Associates, has been ranked as the best Tier 2 firm by the World Tax for 2009-2016 successively in the comprehensive guide to the world's leading tax firms, and also rated as amongst first 10 leading transfer pricing advisors in India. He has authored various books on a range of subjects covering international taxation, transfer pricing, and the black money law in India. He regularly appears as a panelist on Indian business news channels as an expert on international taxation and corporate law. In fact, he just was mentioning that he was there on the Hindustan Times, No Bharat Times, and have viewership of 1.6 million. Yeah, on yesterday only. Oh wow! So he's there on the newspaper on the front page. On behalf of all of us, I request the co-chairman, Mr. Mayur Nayak, to present a memento to Mr. Oswal as a mark of appreciation and respect, sir. Mr. Oswal, please. Thank you. पासवर्ड क्या पासवर्ड क्या है इससे भी कर सकते हैं ना हाँ ठीक है ना Mr. President, Vice Chairman of our Co-Chairman of the International Tax Committee, ex-presidents, and seniors in the profession, ladies and gentlemen, and the viewers on the webinar. In fact, it is a great pleasure to be here on this subject to share some of my thoughts. Some friend of mine this afternoon, I was in a board meeting and we just had a lunch together, and he says, "What are you going to speak?" I said, "Global tax." I said, "Where is the global tax left now? It is anti-global move going on in the world, and you are still talking on the global tax. I don't understand." Brexit has taken place. Of course, today's High Court decision, Supreme Court decision of House of Lords decision, what is the guidance, which I myself do not know at the moment. US, all protectionism measures which you can see, Mr. Trump has already announced, and he will take one by one all the steps. Some of the other countries will get out of the European Union, and then what we are talking under the garb of OECD G20, we are getting into more and more protection. We are getting into one by one regulations which are going to give more power to the revenue officers. So therefore, literally, there is a absolutely attack on freely doing business, and that is going to create a new atmosphere. And the new global tax order, instead of talking tax transparency, I don't know really is the correct word or not, but it is going to be a new challenging task. But with the countries coming into new protectionism measures, whether the BEPS, which is going to happen or which is happening, is going to succeed, or there is a crack already developing, is an issue for us to consider. In the today's discussion, time permitting, I'll cover up everything. But if the time is a constraint, I will have to give up something or may run up something fast. The topics which possibly I'm going to deal with are the president has already said that major changes which have taken place, which is going to impact India in terms of our tax treaties, which we have signed recently. We had a major stumbling block with the Mauritius Treaty. Because Mauritius Treaty was not getting amended, Singapore Treaty was linked with Mauritius Treaty, and Cyprus had taken a very categorical stand that unless you change the Mauritius Treaty, don't tell us. We are not going to change anything. Having negotiated the treaty, went back on their words and said we will not change. And government of India got an opportunity to blacklist that country. They found some excuse because the country was not exchanging the information, and because of that they blacklisted that country. Of course, everything has undergone a change now. This is no more a blacklisted country. We have this year amended 3 major tax treaties which are giving major concession on account of capital gains. And those 3 treaties are Mauritius, Singapore and Cyprus. There was a double non-taxation taking place because of these 3 tax treaties. We had given our right of taxation of capital gains to those countries, and those countries had no capital gain tax in their countries. And as a result, investor in Indian shares was not paying tax in India as well as in other countries. The OECD G20 brought in this subject very seriously, and they said the treaties are not meant for double non-taxation. And it was the preamble of the OECD treaties as well, earlier also, that treaties are not meant for double non-taxation, treaties are meant for relieving double taxation. Contrary to the OECD treaties, United Nations model treaties always said the treaties can result into double non-taxation. One of the objectives of the tax treaty United Nations model was giving tax-paying benefit to the taxpayer, and tax-paying benefit if you give to a taxpayer in a country where investment has come in, the other country if taxes, then whole benefit goes away from the country of the right of taxation of that country of source to the country of residence. And therefore treaties were negotiated in a manner that you give tax-paying benefit to the country where the source of income is, and the country of residence will either not tax it, that income, or will give equivalent credit of the tax at notionally leviable on the source country taxation. And therefore the objective of the tax treaty was double non-taxation. India was negotiating, India has been advocating. In fact, India, if you look at the United Nations tax history, tax paying was introduced in UN model at the behest of India, because we were developing countries in 60s. We wanted investment to come in our country, and we wanted to give concession to all the foreign investors. And if you are giving concession to the foreign investors, you definitely wanted the other government should not tax it, and that was the reason why tax paying. Today, we are absolutely opponent of the tax paying. We say we don't want tax paying. The position is very clear. If you are already having a lunch, you had a lunch, and immediately after your lunch at 2 o'clock, somebody at 3 o'clock, Tarun Singhal, a friend of mine, requests you, can you join me for a lunch? I am giving you sumptuous lunch in Taj Hotel. Will you take it? And you had an absolutely sumptuous lunch before that at 2 o'clock. You will say, sorry, Tarun, next time. Your offer is welcome. I accept, but I'll take it next time. Tarun says, no, it is available today only. Take it or leave it. Because he knew that you are already taken. So therefore, this is exactly our position. Today we are fully full with our requirement, and therefore we don't need tax paying. Possibly we are now investing in other countries, and therefore the other developing countries may ask us to give a tax paying, which we are not ready to. And therefore we have been advocating in the OECD forum platform that remove these tax paying provisions. But please understand, the world is not equal. One size cannot fit all. African countries are still to develop. Countries like Ghana, Somalia, Ethiopia, where they expect foreigners to come and make investment, FDI. Now there is a tug of war between the foreign direct investment versus these tax laws. And therefore, those countries want to give tax paying, and if suppose we are in a position to negotiate the tax paying with them, what would be the fate of a BEPS? That is an issue by itself. Once the BEPS and GAR comes in our country, I don't know really whether the treaties are relevant at all. That will be another question which we have to debate, and therefore whatever we have negotiated with these countries, Mauritius, Cyprus and Singapore, benefit of those treaties possibly could remain for a short while. If you look at the Mauritius treaty which we had, 33 years old tax treaty which Mrs. Gandhi had signed, and at that time we gave a concession to Mauritius because knowingly well the more 75% of the population at that time was Indian. And we thought that we are a big brother and we would like to give more and more concession to that country. At that time the country was not developed at all. And therefore we never expected that Mauritius will make an investment in India, but nobody knows. In 1991 we opened up our economy for foreign direct investment, and exactly at that time South Africa got liberated just a year before from Britishers, and Mauritius thought that all investment from Mauritius will get attracted if they make it attractive zone, and therefore they converted themselves into the financial center and done away with the capital gain tax. Consequence was very simple. Having removed the capital gain tax and having got the treaty with India wherein the right of taxation was with them, not with India, double advantage got it. And it was India shining. Everybody in the world was coming to India via Mauritius. We have now given away that right of exemption in the Mauritius. We have grandfathered the investment clause. For example, what we have said in the new treaty protocol, which you have signed, any investment which have come in from Mauritius, and the same is the case with Cyprus and Singapore, with some variations which I'll explain, then the treaty benefit will be available perpetually till the investments are not sold. In other words, old clause will still continue subject to limitation of benefit and the principal purpose test, but the exemption, the tax will not be levied. And same is, we have extended the benefit to Singapore, same we have extended to Cyprus. But in Mauritius and Singapore, the limitation of benefit article exists, which is an expenditure test, which we have to fulfill. But if your investments are made after 1st April 2017, but before 31st March 2019, in the span of these 2 years, if it is long term, in India, it becomes long term after 1 year. Anyway, it is exempted. But if it is buying, selling, trading, short term, as per the earlier treaty, it was exempted. But now they say under the new treaty, 50% of the tax will be levied. Normal tax leviable on the investors in India and a listed company share is 15% on a short term capital gain. In respect of the investment coming from Mauritius, it will be 7.5%. So also with the Cyprus and so also with the Singapore. And then thereafter what they say, after 2019, 31st March 2019, any capital gain made by an investor from Mauritius, other than those which have been invested prior to 1/4/2017, will be subject to full rate of tax. So full capital gain tax will apply. In case of a short-term capital gain, 15%. In case of a long-term capital gain, of course, it is on a listed share is zero tax, unless what I am talking to you today changes on 1st of February on account of the budget. Interestingly, if you look at the Article 13, it talks of only shares. Article 13, sub-article 4. And therefore, anything which is not share is not covered by that article. Possibly next article, sub-article covers that, Article 13.5. And therefore, there is a view taken by people. Derivatives and fixed income securities possibly will get out of Article 13.4, but will get into Article 13.5. And on that, the country of residence only has a right of taxation, country of source has no right of taxation. Still, therefore, double non-taxation is effectively possible. So, in a way, India has nullified the benefit of capital gain tax exemption. It is in fact, frankly speaking, like one can say, USA does not have any tax treaty without limitation of benefit article. But I can't make a general statement like that, because despite these 3 treaties got amended, if you look at number of other tax treaties, also capital gain planning is possible. For example, Netherlands, you can see France, you can see Spain, and there are a number of other treaties, and therefore, but blanket exemption without any conditions, these 3 treaties that has gone away. Reason why is going to substantially impact. Mauritius has been a major investor. All the world is investing. in India via Mauritius. The investment from Mauritius of 2016, if you look at, virtually it comes to 32%, 10 to 16. And whereas other countries' investment is far below Mauritius, and therefore this is a major blow to Mauritius. There are other few changes also one should look at this treaty. Earlier, there was no provision of rate of interest on the payment of debt instrument interest, interest on the debt instrument raised from Mauritius. And if your instruments is debt instrument and the interest was not provided in the Mauritius treaty, it was subject to tax as per Income Tax Act under section 115A. And if the debt is in a rupee terms, then the rate of interest TDS was almost 40%. If it is a dollar denominated debt, possibly the interest TDS was 20%. Now one good thing which has happened with Mauritius, the interest TDS has been now subject to tax in the hands of the recipient, has been provided in the treaty at 7.5%. And therefore this is the lowest interest TDS in terms of any treaty India has. Other treaties have 10%, but they have scored on this. And therefore today, if you ask my view, Mauritius has become a good center for not only raising equity but also raising the debt capital. Hitherto, people were raising the debt capital from Cyprus because it was a rate of TDS was 10%, and that has not undergone a change. It is same 10%. And Singapore was 15%, and that has also not undergone a change. Unfortunately, I don't know, Singapore was the last country to negotiate new protocol, and they have not been able to successfully negotiate with India, and the rate of withholding tax is still continue to be 15%. Another major feature of Mauritius tax treaty is that we have now got fees for technical services under the India-Mauritius tax treaty. If somebody was giving technology to you from Mauritius, it was not subject to tax because this was not an article there in that treaty. And therefore it was, if in absence of permanent establishment, it was subject to business profit tax. Now there is no, there is a specific provision, and the rate of withholding tax on fees for technical services is 10%. And the next important change, which if you look at, if you restructure the organization, if you transfer the shares free of cost to another group entity, the recipient of those shares without any consideration, if you apply section 56 of the Income Tax Act, in the hands of the recipient, it was subject to tax as other income at full rate of 30-35%, whatever the case is. And Mauritius was one protection. If Mauritius treaty was applicable and the recipient was receiving anything without any consideration, under the India-Mauritius treaty, Article 22 said income from other sources is taxable only in Mauritius. That they have amended. Now after 1417, that India has a right of taxation of other income, and therefore section 56 will still apply now, and therefore one has to really trade between the treaty and the domestic law very carefully. Mauritius had limitation of benefit article. That article expenditure test continues to be the same. You spend 2.7 lakhs Indian rupees, 2.7 million Indian rupees, or equivalent to 1.5 Mauritius rupees in Mauritius to get the benefit of the tax treaty for capital gain tax, continues to be the same. This is known as a limitation of benefit. But now two things which they have added in Mauritius, that is limitation of benefit article under Article 27A. If the Mauritius resident want to take the treaty advantage, then he has to prove the main purpose of the treaty is not to take tax advantage, and the bona fide business test. You are a bona fide investor from Mauritius, and that test is going to be a challenge. And with the GAR coming in, Mauritius having these changed provisions after 1/4/2017, as I said to you earlier, it is a challenge to be seen whether this treaty is beneficial and still is available. And therefore the challenge for the professionals will still continue, because the tax officer will take different view. Unless in India the tax administration is toned up properly and told that you take the view correctly, legally. If you do not take the view correctly, you can be held up. Recent circulars, you can see that we have last week only received a circular how the dispute resolution should take place. Appeals should be withdrawn in case if the appeals are routinely filed. C&AG's orders, directions or objections or memos does not mean that assessment should be reopened and appeal should be filed against the orders, and that is a good move. The government of India, for the first time I am seeing change is happening in Delhi. Let's hope the change will still continue to be the same. Same is the case with the Singapore. All the changes which I have said about Mauritius remain same. Expenditure test in the Singapore, which was there 200,000 Singapore dollar, continues to be the same, and therefore there is no major change as far as Singapore is concerned. Capital gain tax exemption will continue to be on the same basis. Cyprus was another jurisdiction which had the similar problems. The Cyprus had major problems with India because they are not ready to exchange the information with us, with our country. And when they did not pass on the information of some of the investors which made investment from Cyprus in Indian companies, the Indian government notified in 2013 that this is a notified jurisdiction under section 94A. Of course, with the revision in the tax, that was already they started giving information, but the government of India took the situation to their advantage. They said, now you have given information, all right, but we will not notify you till you revise the treaty and sign it with us. And that was a blackmailing tactic, but of course every country is entitled to do that, and India has taken advantage of that, and rightly so. And Cyprus was pinned down, and Cyprus was told to sign new treaty, but by that time Mauritius treaty was signed, and therefore Cyprus had no other choice. If Mauritius was agreeing to sign the treaty, what is left in Cyprus or Singapore? Singapore was only linked with Mauritius, and therefore all the treaties have now fallen in line with each other. Rate of tax on royalties has now been reduced. Fees for technical services royalties is now reduced from 15% to 10% in the Cyprus treaty. And the definition of permanent establishment has little been widened. I don't want to go into the details of each of these items separately because it's a topic by itself. We can take it up later on. Friends, we are talking about the globalization, the tax impact of the various situations happening, and now we have two major things which we should note. And as a practitioners, we should all understand, even if you are a taxpayer, you also should know very well what are the obligations and what are the consequences of the two of the items which I am discussing just now. We have two developments on account of automatic exchange of information, financial account information from one country to another country, and second is Foreign Account Tax Compliance Act, FATCA. First is the OECD countries have come together and G20 countries have come together to sign a multilateral automatic exchange of information. All the countries, at least more than 100 countries, have signed signatory to that document, and they say, all right, we will exchange the information in relation to any taxpayer from the other jurisdiction. Suppose I open an account in, say, any tax haven, maybe say Switzerland. Then my account is based on my passport detail. So my passport details will be the basis for them to share the exchange of information. New KYC documentation which every bank is required to obtain is TIN number of each country, tax information number which is equivalent to our permanent account number. So you may have to give permanent account number. But suppose you are a resident of other than India. You are a citizen of India but resident of other country. You are a passport holder of India but not staying in India. You may not have tax exchange PAN number in India. May or may not. In that event, the information will be exchanged with the country where you have a PAN number or TAN number, the TIN number in that country. And that country will get that information about you. And then the tax authorities of that country will be entitled to look into your financial information and find out whether that financial transaction has been reported to that country. And if not, then they are entitled to make an assessment on you. Exactly what we are doing in India. And therefore, now there are some issues which comes up for consideration. Whether the information will be exchanged as per the multilateral automatic exchange of information document which the countries have signed. They say any person, they don't talk of citizen, they don't talk of a resident. As a designated person having a TIN number of a particular country, exchange of information will take place in that country. So therefore, when you have to file a declaration in the bank in the other country, and if you are having a TIN number of more than one country, tax registration number, then you better disclose the tax registration number of a country where you are a resident. If you disclose all the countries, possibly they will pass on the information to all the countries. If you are resident of a particular country where the bank, it is advisable, if you are resident of say one country, Dubai, UAE, better ask the bank to record your local address. Ask, and when they will do that, when the bank will do that, bank will do it only if you have a local address available. there is an evidence of that, there is a utility bill you have got, and there is another evidence which proves that you are resident of that country. You have permission to stay in that country. And if you exchange that information on the banking system, that will be information reflected and recorded. I have even come across, if you are a non-resident Indian and Indian passport holder, you can, and you are residing in that particular country for a very long time, go to consulate there and ask on a passport also change the address, they change it. And therefore you prove it that you are resident of this country and you have got an address proof and the KYC document, the passport, the Indian consulate abroad, change your residential address, and in that case the life becomes little simpler, much better simpler, because the other country having the details of your passport will know very well that you are resident of this particular country, your passport shows this detail, and therefore exchange of information will take place with that country. Friends, this is a very, very valuable and important advice to the countries, to people who are residing in the low tax countries and Middle East, particularly where there are no taxes. So that if they earn income anywhere, because you are a citizen of India, because in Middle East you can't be a citizen, so the other banking, and you have got an account elsewhere in the world, bank will not share the information if your records are neat and clean in relation to the UAE accounts. Then they will not share the information with the bank, with the government of India. Otherwise, they will routinely pass on the information to the government of India, and the government of India will routinely issue notices on you. Of course, as a chartered accountant in practice, you will have a chance to defend them and say that this is the position. But why create a problem for yourself? That was my point. And this is an automatic. It's any account, whatever account you want to open, whatever financial transaction you want to do in other country, whatever sizable purchases of goods, and there is no financial limit on that, which takes place. Now, the country's tax authorities, every bank, insurance company, security agent will have to pass on that information to the exchange of information authority in their country. The exchange of information authority in that country will pass on that information to the other country of which you are a resident. And therefore, it will be automatically taking place at the end of the year. Full year's transaction will be reflected and reported to the other country. And therefore, you will be on the job to defend yourself that this is legal, this is valid, this is rightly done or not done. That's all different story. So this is one is going to happen. It has the program of exchange of information. The government of India has signed in 2015. Other countries have joined in 2016. First exchange of information is going to take place of 2016 in 2017, and that information will be processed by the tax authorities in 2018, and the Revenue Office will issue notice to the taxpayer in 2018. And therefore, right now nothing is happening. Don't be under the impression nothing is happening and therefore you are safe. Behind the door, everything is cooking in, and therefore you have to guard you against that. If the compliance of documents, if they systematically compile the documentations and keep it ready so that you can defend yourself and your client. So this is what, and India has already changed the regulation to get this information agreement under section 285BA and exchange the information to implement this agreements which India has signed on the CRS, that is known as Common Reporting Standard, and FATCA. India has signed this agreement. FATCA is particularly with USA, and therefore this is going to be the order of the day. 2017 information countries, 54 countries will be exchanging information with each other of 2016, and 47 countries will be exchanging the information in relation to 17. They have signed little later. So they will compile the data of 17 and exchange with other countries in 18. There are other countries which have joined now. They will compile the data of 2018 and will exchange the information in 19. For example, Switzerland. For example, the UAE, now Japan, Singapore, Hong Kong, they are now signing. So therefore, those information, they are latecomers for their own objectives. In fact, I was told when I was talking to the competent authority in India 3 years before, when the government of India was ready to share the information and ready to sign, it was one drive the Indian competent authority was very interested in doing that. But then when they realized that a lot of non-residents' monies are lying in India, and if we go on sharing the information of those non-residents, why they are bringing the money into the country? Because non-resident external account has no tax liability. and foreign exchange deposits of the non-residents was bearing no tax, and therefore a lot of foreign exchange deposits came in from non-resident, around 30 to 40 billion dollar. And if that money would be subject to interest thereon is subject to tax in their country, what will happen? The monies will be withdrawn. People will try to arrange the techniques whereby they will transfer the monies to various persons, and that has been happening. It is not the case, it is not happened. And therefore that is one. Otherwise our foreign exchange reserves by this time should have been 450 crores, $4 billion. But we are still struggling to maintain our foreign exchange reserves at around 360 billion dollar, is mainly because of the another foreign exchange bonds which were matured, 40 billion dollar, and another this non-residents withdrawals taking place. Despite that, inflow of money in this country is good. As a result, we have been able to the impact on foreign exchange reserves in this country is only $10 billion, not substantially. The information exchange, there is a standard format which has been prepared and created by the countries, and that common reporting standard under which they will ask you to provide this information. Each bank is required to give the information: name and address, TIN number, date and place of birth, and of each of the reportable person, account number, name identifying the number of reporting financial institutions, account balance, value, any depository account, custodial account, and any other account not mentioned above. But luckily, so far, the information exchange is only restricted to the financial exchange of information. Immovable property related information, so far, nobody has asked for. But next move, I understand from the regulators in US, they says we can't do everything together. And we do it by design, systematically. So they have started with the financial exchange of information gradually. The days are not far off. They will ask for the information or the immovable properties as well. And therefore, one should be guarding himself in keeping these things ready. Automatic exchange of information, we have got the number of agreements which we have signed. We have compelled even Mauritius, Jersey, Guernsey, Malta, and other countries. Host of the countries, 43 countries, we have signed based on the OECD standard of automatic exchange of information, sign an agreement with us, and they have done it. Next move is FATCA, and therefore India is concerned. And India, please note, India is playing pivotal role, major role in doing all this development. We believe that we are not a very superpower. But in terms of this sort of things world over, all negative work we have to do, India is expert, and we have been really making the OECD mad. We play a major role, and thanks to our authorities, they are quite competent, and they are signing all these agreements with a due attention and due care. 2015, we have signed an agreement which was also delayed by 3 years. Again, reason same. Our authorities wanted the people to regularize their accounts. In 2015, ultimately we signed an agreement with USA. US is a big brother attitude. They said, we don't believe in automatic exchange of information of the OECD. Our way is our way. We don't believe in others. So we have created our own agreement standard, which is known as Foreign Accounts Tax Compliance Act, FATCA. And we have signed intergovernmental agreement, IGA 1 and IGA 2, with each country separately. And that was negotiated with India for a long. And eventually they said, this is a deadline. By September 2015, if you don't sign, tomorrow onward, any payment coming to any entities from US, we will slap 30% withholding tax. And if you make the payment to India, any entity, we will ask 30% tax, like Section 94A of the Income Tax Act. The government of India fell in line. But one thing is we must compliment government of India, that we bargained hard. And finally, Americans were saying that you sign an agreement and you share the information with us. We will not share information from our country to you. Indian government took a position, sorry, it cannot happen. Our Reserve Bank of India and our Securities and Exchange Board of India require us to exchange information bilaterally. If you don't want to if you don't want to share the information to us, we will not share the information with you, and we are not ready to sign. Even if 10%, 30% tax is to be deducted, you deduct, we will see, we will also do that. So therefore, we will not sign an agreement of IGA. And ultimately, government of US agreed, and therefore we have been able to persuade them that there has to be bilateral exchange of information.
You provide the details of Indians having account in your country. We will provide the details of Americans having an account in India to your tax authorities. Luckily, lot of non-residents have been it in non-compliance. They have been operating accounts. They are saying this is non-resident external account, but all the details are passport details were given when they opened an account, and all their addresses are Indian addresses. In number of cases I have come across, in number of cases the American address is not there. There is no clue. There are some standard tests which have been laid down. How do you find out whether a person is an American or not? Does he have an American address? Does he have American TIN number? Does he have American phone number? All sort of a thing. Or any authorized signatory from USA is operating on his behalf. 6 or 7 tests have been there. And in case if those tests are not fulfilled, if the person's account is an Indian account, if the account holder does not have, a bank does not have a record of foreign citizenship, etc., possibly information will not be shared. No country will exchange the information about the national of their country with any other country. It is like digging your own graveyard. Why should you do that? And therefore, possibly there will be some saving device. I am only giving you my view. You are entitled to take your own views after careful consideration and consultation of top people. We have best of the people available on our in our panel here, sitting here, like our Mr. Hegde, etc. I think Mr. Hegde should do a yeoman job further by writing some book on this, like what he has done on TDS. I must compliment him. Such a complicated subject in such a small booklet which he has written, section 195, is a phenomenal. Hats off to Mr. Hegde that you have done a good job. I can see that because compilation of this data in such a small booklet is a challenge by itself. Somebody can write an article which will be running in so many pages, but it is comprehensive. I was seeing the number of case laws which he has reported under each of the heads of the income. So similarly, Bcas should make an attempt to get a FATCA compliance or a the CRS or the automatic exchange of information guide to public, and possibly that will help people to understand that. Main difference between exchange of information of the other OECD countries, CRS and FATCA, is in the automatic exchange of information there is no financial limit. So every transaction is reportable. In FATCA there is a financial limit. If you have initial reporting of 2000, it is a retrospective. We signed in 2015, but the information will be of 1st July 2014, which will be shared with the other country, which has been already shared with the other country, and a lot of notices have started coming into from the income tax department. If you have a balance more than $50,000 on 1st July 2000 or equivalent or more, information of that account will be shared with the other country. A lot of students going abroad, they suppose are still Indian resident, and they have got father and mother sending the money through Hawala route in their account abroad, then they have little trouble. So they should guard themselves against on this subject. The developing countries will be on a receiving end. Those who are active developing countries like India, they will be trying to use information to their advantage as much as possible. We are one of the countries in the world. We have maximum information requested the other countries, and we have received the information from the other country. There are no other country other than India which falls in that league of 70 to 80,000 information which we have shared so far. And therefore, we have created a department by itself. We have no other work. We have a number of human beings, enough number of human beings to handle such matters. We don't need a technology, and we are masters in doing that. So therefore, confidentiality, so one of the factor which was very relevant, countries were asking when the Americans signed FATCA with us, they were also reluctant to sign agreement with us because our standard of confidentiality was very, very poor, lowest in the world. We were not maintaining any confidentiality. Today also it is the fact. Though then the government of India assured them, sir, we will maintain. Then the government of India issued a circular threatening any officers and every officer sharing information with anybody, you will be penalized. The circular was issued. But what happens? In India, do you think circular has an impact of this nature? There is no such impact at all. Supreme Court of India had given the information which was shared with Supreme Court, with the SIT, with the Special Investigation Task Force. The information which the government of India had received from French government and from German government, which under a compulsion. Finally, Supreme Court says, otherwise, if you do not give the information, a contempt of court will be issued. Government of India surrendered, gave that information. Next day, without opening the envelope, Supreme Court Chief Justice says, sit, please sit on this and take it. And they gave that information. And that information was released in the newspaper, third day. So if this is the fate, Americans were very fussy about it, and they were rightly so. There were a lot of assurances were given, but now today the assurances have no value because our officers are smart. What they say is, we abide by your circular, we will not share the information with anybody. But they know investigation wings need this information, dial him and tell him about everything on phone. Information is exchanged without any record created on account of exchange of information, breaching of confidentiality. So therefore, confidentiality is very important. Friends, this is the virgin area of tax practice. Fantastic opportunity. And if you really specialize in this, you need to take a global pass of any airline to travel and meet the competent authorities of each country. I had an experience of dealing with at least 3 countries' competent authority when the information exchange was taking place, and we could present the case that this information is not relevant. And the government of India is asking the information. Government of India is so smart. When they communicate with the other competent authority, they don't communicate with the taxpayer. But other country requires, the law in that country requires, you must share the information with the taxpayer, and they pass on the information received from government of India to the taxpayer or their representative. As it is with the covering letter, all the communications received from Indian government. Therefore, we come to know why the government of India is not sharing. And therefore, this is the area where we should know and how to find important objections, whether this is meeting the standards as expected under the Exchange of Information Agreement, as expected under the tax treaties. Look at Exchange of Information article. Look at section 20, article 26(2), where they say you exchange the information. You have to exchange the information in case if there is a tax fraud involved, or if there is a prosecution launched against you. The smart method government of India has followed. They will call a taxpayer, record a statement, and sometimes the client says or the taxpayer says, I don't know the answer. That's all, more than enough. They will not say anything, thank you very much. And then the next day they will send you prosecution notice. You have lied or you have attempted to hide the information, and therefore prosecution is launched. Once the prosecution is launched, the government of India communicates with the other competent authority, hey, there is a prosecution, criminal action which is taken against him, and therefore now he is a criminal, so therefore please exchange the information. And the law, the agreement says, if there is a criminality involved, you will share the information. But if you look at the section article 26(2), it says criminality in respect of tax fraud. If the statement is recorded and statement is not found to be correct in your opinion, which is judgmental, and I have said what? I do not know, and genuinely I do not know. So how can it be wrong? And therefore, the authorities concerned in the other countries have denied exchanging the information on this simple ground itself, provided you can make out the facts and tell the people. Next item is the world, as President has said, we are now going through a turmoil. Under OECD G20, all revenue officers came together. There was a time businessmen took full advantage of the tax laws and loopholes. Now all the officers of the world have come together and they say, okay, hey, so far your days were there. Now it is our day. We will not allow you to do so many things. Why? They say there is something called as base erosion is taking place. And because of base erosion, how it is taking place? Because you are shifting the profit. What is base erosion and profit shifting? It is a new name to the old methods in India people were also doing. Profit was shifted from a profit-making company to the loss-making company. So losses are set off. You don't pay the tax there. Profit is reduced, and therefore base erosion is taking place of a profitable company, and the profit is shifted to the other entity, and therefore it is set off. You don't pay tax either at both the places. So base erosion and profit shifting was a technique. This is a domestic technique which I said, but if it involves cross-border, You are shifting your profit to other country by paying minimum possible tax, withholding tax here, and not paying any tax over there, or paying minimum tax over and above withholding tax which you have deducted. Base erosion was taking place. The best example after 2008, the meltdown of the world economy, US economy, the first and the best example which came to the attention of the world was Apple and Google. The double Irish sandwich structure. Ireland on the top, Netherlands in between, Ireland at bottom, and the rest of the world. People were making payment from rest of the world to Ireland. Ireland was making payment to Netherlands. Netherlands was making payment to again Ireland. And Ireland top company was controlled by a Bermudian company. So it was a subsidiary of USA, but control and management was in Bermuda. So they were not liable to tax in USA. It is an active profit. So they have said no CFC will apply. And therefore US they were not reporting. Such companies were target because they made 70 billion profit, paid only 1 billion tax, or maybe less than that. And therefore the US authorities at their behest asked the OECD, do something because we are losing a lot of revenue. And when all the officers came together, they said, yes, genuinely it is the case. We see your problem. That similar problems at a lower level exist in our countries also. Like in UK also Google was not paying tax. Like in India also Google was not paying any tax. And the consequences you could see. Britain introduced the Diverted Profit Tax Act. India introduced equalization levy, though imperfect. Australia introduced the base erosion tax, another name. Saudi Arabia introduced, Kazakhstan introduced. All the countries fell in line. And therefore, the world is now shifting to a new target area, and that is following the order of the BEPS. Look at this chart, simple chart. If you look at the British Virgin Island, very tiny island in the West Indies, Caribbean islands, very tiny, less than 50,000 population. Foreign direct investment was 86,297% of the GDP. Bermuda, 6,715% of their GDP, foreign direct investment. Cayman Island, 8,315% of their GDP. Then OECD average was 36%, all the OECD countries. Foreign direct investment is in proportion to, normally it should be in proportion to your economic activities in those countries. Like India is a country where substantially investment takes place because they want to genuinely undertake the activities. But these are the countries where no genuine activities, all tax havens and foreign financial centers wherein people make money and invest, park there, and therefrom they deploy anywhere else in the world, make money out of that and still don't pay any tax anywhere. And that came to the attention after the great study, and therefore BEPS action took place. And what is that BEPS? On 19th July 2013, OECD released their 15 action plan. They want to, the basic fundamental principles they brought in was that there must be realignment of tax based on substance. The coherence of corporate tax at the international level must exist. And transparency coupled with the certainty and predictability is very important. These are the three fundamental principles based on which they said base erosion and profit shifting action should be taken up. And they worked out 15 action plan. Eventually they issued the draft in December 2015, which were finalized in November 2016. Which are those 15 action plan? 3 action plan or 4 action plans are related to transfer pricing. Action 8, 9, 10 and 13, documentation. They are purely related to transfer pricing, and they are going to create major headaches in the world than what transfer pricing laws today we have, which you can see, something possibly time permitting I'll speak. Then you have hybrid mismatch. First of all, first action plan was the digital economy. Digital economy was the first action plan. But Americans always do the things which is suitable to them. So Americans objected to the OECD's work. He says, what nonsense, what are you talking about digital economy? You want to tax all digital companies in the world. We are the leaders of digital economy. How can you tax us? So therefore, there was a shivering in the OECD. They said, okay, don't worry, because OECD's 25% of the budget comes from the USA. They say, we'll stop budgeting your expenditure. So the OECD says, okay, we defer that action plan for 5 years more. By 2020, we will be able to come out with what should be concrete action plan on the digital economy. But meanwhile, they told countries that whatever you want to do under domestic law, please do this, do that. But it should be in accordance with the treaty provisions. You can change your definition of permanent establishment. You can create digital transaction tax, or you can create some tax on the digital transactions of this nature. Every country, it was left to each country separately. And one of the action plan the UK brought in was diverted profit tax. This was much before this action was finalized. And they says we want to tax the digital economy, but in the process of taxing digital economy, they are now, as per their law, they can tax even the physical goods as well. If you are successful in avoiding creating permanent establishment in UK and diverting the profit which otherwise was legitimately receivable for the activities in UK and on which tax should have been paid, but you have not paid any tax, UK says 25%. UK's corporate rate of tax is, by the way, 20% today, which is gradually going to reduce to 15%. Next year it will be 19, 17 and 15%. But UK says if you have diverted profit from our country, we will straightway levy 25% of the tax. And 25% tax will not be given credit. This is not an income tax. It is a diverted profit tax. And therefore the treaty provisions will not apply, and therefore you are now speaking on behalf of the other countries. And therefore you should not get credit in the other countries. How can you speak for on behalf of the other countries? It is like Rasmin Bhai here saying the digital economy, we are creating equalization levy. It is not an income tax, but it is a separate law. Under the Finance Act, we have created digital economy, and we would like to tax under that law. And therefore, you will not get credit in the other country. But who are you to say that? It is for the other countries' tax authorities to judge whether is tax akin to income tax. And if it is akin to income tax, is similar to income tax, Article 2, Sub-Article 2 of the tax treaties covers such taxes, and therefore possibly one can make out a case that I should get a credit in your own in the country of receipt. These are the points I am raising. You can take advantage if you so desire. If you want to, if you don't want to take, you fall in line. Don't want to create controversy, fall in line. Hybrid mismatch was a second action. Here luckily we are not major impacted. Reason being, we do not have hybrid instrument and hybrid entities concept in our country, but we have to deal with other countries where this hybrid mismatch takes place, wherein the hybrid instruments also are raised and hybrid entities are also available. For example, you look the company in India, it as a company, other country looks it as a partnership. In India, you look it as a equity, the other country looks it as a debt, or vice versa. You look at it as a debt, so withholding tax at a lower rate will apply on interest. The other country consider this is not a debt, in substance it is equity, and therefore dividend, we will consider interest received as a dividend, and therefore we will not pay the tax, we will not levy the tax. These are various type of transactions. When we are dealing with the world, you have to open up your mind. You have to keep your ears open and eyes open. You must be receptive to the new ideas. What you should not think, what you know is the only way world people are following. We always believe it in India that whatever we know is the final, that's all. That's not the case. In international tax, you must be receptive to understand the new concepts, and this is one of the items. Third, next action plan was in relation to CFC, Controlled Foreign Corporation. You can expect the amendments in the Income Tax Act in the finance bill, which is going to be placed on 1st of February this year, because India has been propagating the CFC regulation under the OECD. And we have created the CFC, but the way in which CFC regulation of this OECD BEPS is created, it means virtually today you can see your poem which has been defined, the circular which was issued to you yesterday, which is 10 pages, only 4-letter poem, place of effective management, words required to make it people understand. 10 pages of the circular. What an irony. You know, this is the problem of this country. You have no simple way of explaining anything. You have brought in the concept of active and passive income. Under the Income Tax Act, I have not seen these two words, and therefore the circular goes beyond the provisions of Income Tax Act. How can you define new terms under the circular which are not in existence under the Income Tax Act? And therefore these are the concepts which they have brought in. If you are a company abroad which has an active income, which has a passive income, what will be considered as a passive income? If you are doing a transaction with related parties, it will be more than a particular percentage, it will be passive income. All sort of a confusion, all sort of a chaos which has been created. We have defined POEM. We want to tax foreign company, Indian companies subsidiary abroad, their income in India, but we don't want to give credit. The POEM must come along with the rules. All other consequential changes to be made under the Income Tax Act. They have not made any changes. You want to have one-way traffic. We want to tax you. That's all. We will not refund you. So therefore, if foreign company has earned income abroad, has paid the taxes abroad, which is lower than Indian tax rate, the tax paid abroad must be given credit if you are taxing that income. Now, they may say, yes, we have elaborate rules which you have created under section 90 or 91 are not adequate. In my opinion, this requires a serious attention and careful consideration. We have harmful tax practices as one of the items of BEPS action plan. Countries were competing with each other. Now they say if you are taking advantage, if you are giving undue advantages, we will have problems. Preventing treaty abuse. If the countries are signing the tax treaties and the taxpayer is abusing the tax treaty, there is an action which has been proposed, Action 6, avoidance of permanent establishment status in a country by virtue of using the tax treaty is another Action 7, 8, 9, 10 and 13 I have said to you about the transfer pricing. Action 11 is mainly for the revenue officers because they have to analyze the data and what are the methodologies used. It is for their purposes. And the disclosure rules on Action 12 and dispute resolutions under Action 14. These are the 15, and last Action 15, multilateral instrument. Now we have said multilateral exchange of information agreement, but now there is also another multilateral instrument, MLI. What is this MLI is, which we will see within short time. We have now 15th action plan, draft of which was already announced, released last month, and more than 100 countries have agreed to sign multilateral instrument, which will have an impact possibly. I am covering up those subsequent topics right now explaining because I am running out of time. I thought that I must share as much information as possible. The countries are signing multilateral instrument. Why they have created multilateral instrument? Because they believe India and other countries have signed treaties with each other. There are around 4,000 tax treaties each country has signed with other, all put together. And if you have to amend all the treaties, you have to go through the whole process. You have to go to India is one country where signing of the treaty is very easy. You just take the approval of the cabinet committee and your revenue secretary or joint secretary is entitled to sign the treaty. He can negotiate. He doesn't consult anybody. He doesn't inform public. He doesn't take anybody's views. He thinks I am the boss and he can do that. But other countries require a draft agreement signed with the other country to be approved by the parliament of their country. And once it is approved, and some of the countries, like country like Switzerland, not only federal government's parliament should approve, each canton, state, there are so many states in that country, each state has to approve that agreement, Austria, Switzerland. And therefore the approval process takes quite a long time. But Indian process is very simple. Take a document, get it signed, approve it, cabinet committee only approves. It comes in the minutes, nobody signs it. And thereafter the country's competent authority can notify, ratify, whatever they want to do. The treaty comes into a picture. But if world has to sign all the treaties to fall in line with the OECD order, it will take years together. So therefore they have created a smart way. Each treaty, over and above the treaty, there will be one more document. And that document is multilateral instrument. And on that multilateral instrument, they have come out with some actions and they have signed. Each country have agreed to sign. And there is a deadline date which they have said by 30th June 2016, all the countries will sign. Those who are intending to agree with this multilateral instrument, they will sign those documents, and thereafter later on other countries will sign. There are a lot of implications, it's a topic by itself. It is not something very easily to be done with, but simply I would say in future, if the two countries have an agreement with each other and both the countries have signed multilateral instrument, then over and above the agreement between the two countries, you will have to read together a multilateral instrument. So two documents put together, after reading only the treaty will be complete. Till then the treaty reading will not be complete, and therefore you will have to understand what multilateral. Now there are a number of consequences. The OECD said on each of the concepts they have given options. Say, okay, you agree to sign this agreement? Yes. You agree to sign the agreement? I said no. Okay, in that case this is not binding. Why you don't sign? Because of this. There are 4 options they have given. I say for me option 2 is appropriate. For him the option 1 is appropriate. There are differences. So they are bound to have major differences. That is one area of problem which is going to happen. There are some common 3 or 4 areas which they have said compulsorily everybody will have to follow to the line of action. For example, in case of dual residency, competent authority will decide in the case of companies. There are some other areas of the multilateral instrument which is quite common, 3 areas. And there are other areas which they have said recommendatory. For example, if the disputes are there on interpretation of tax treaties the foreign taxpayer has, then the mutual agreement procedure article is invoked and the dispute has to be resolved by the competent authorities under the mutual agreement provision of the tax treaties. What they say, within 2 years, if you cannot resolve the dispute, then the matter has to be compulsorily referred to the arbitrator. A third party, an arbitrator panel will be from expert countries which will take. Country like India said, sorry, we don't agree. This concept is not acceptable to us because it amounts to giving up my sovereignty, and therefore we will not accept the arbitration procedure. And believe it or not, India was supported by almost all developing countries, and therefore world is on divider again. On one hand OECD countries, on the other hand India, China, all other developing countries, BRIC countries. They say we don't agree with. India is the only country which makes noise and they participate in all proceedings correctly, properly. We understand the law, we debate this properly, and we make our point of view. There are a number of developing countries which do not have any views on that, and therefore what they see, what India says, we look at that and we say yes, we agree with India. That's the way. And that is exactly, I have been participating in these meetings abroad and in the UN and OECD, I know what is happening. And therefore, this is what is going to change. This multilateral instrument is going to come into force in the 2018 possibly, and therefore you will see all those who have studied the tax treaties so far will have to forget that first. Relearn how to interpret. The BCA will have absolutely no problem. Our courses will continue. Equalization levy, least I speak, is the best. All of you know very well. We have created a law, one-sided, 6% tax. We are giving, are we doing really favor to foreigners? They were subject to tax at the rate of 10%. We lost most of the litigations in the tribunal. So we felt that this is the best and simple way. Ask Indian who is paying to deduct and pay the tax. Deduct means where is the provision? So you pay out of your pocket. So when I pay to make use of the digital economy, or I pay the foreigners to do a transactions on the digital mode, 100 rupees, I have to pay 6 rupees to the government of India by way of chanda, a tax, equalization levy. And he will not get, now we say he will not get credit in his country. God only knows whether he can get a credit. Some countries are very vibrant. They say, why not? We'll give you credit. I had a discussion with the other countries. He says, if you produce the necessary evidence that the payer has paid you, paid this tax, which in our opinion is akin to income tax, why not? We should not give a credit. So these are the number of issues which are going to raise on equalization levy. Diverted profit tax, I told you earlier that when you create a situation whereby artificially you avoid physical presence and permanent establishment in UK, and you divert your whole of the profit from UK to the other countries, and Ireland, so UK says, oh wow, you have adopted new techniques whereby you are taking away money from UK without paying any tax, pay now 25% tax instead of. And this will apply not only to the services, royalties, but also it will apply to the goods transaction. And therefore, all type of transactions they brought into the tax net. And that is going to be a major, if you are advising a client client which is doing business in UK, mind well, please take care of this situation. Australia similarly has brought in multinationals anti-avoidance law. Then they found that multinationals anti-avoidance law may not be adequate. So therefore, this is over and above multinationals anti-avoidance law. They also have Diverted Profit Tax Act. They're confused. The world is now getting confused. What should we do? We should not lose our revenue. And how do we protect our revenue? People are going to lose the money just like this. So therefore, this is, at least if this provision is not there applicable, this will apply. So all sort of provisions. India is not the only country. Exception is, we are not the exception. The world, there are a number of countries which are also doing the same thing. Patent box regime. Patent box, you can create the patenting your ideas. Patent box regime, India, you all know what patent box regime is. This has all started when the BEPS action started. The countries found we must attract some investors. Our own country's investors should continue to be in our country, pay taxes in our country. So they say, if you are inventor of technology, you register yourself, you are a technological inventor, you register your patent, we will give you concessional rate of tax. Number of countries have come out with a 10% concessional rate of tax. But India, as usual, is very innovative. We say, innovator must be in India, technology must be patented in India. And foreigners also can do that. Then you also have 10% tax regime in India, subject to a lot of riders attached to it, and Indian patent box regime, which was brought under section 115 BBF, which also talks of 75, the patent box. Expenses will not be allowed, gross payment of tax will be at 10%, no carry forward and set off of losses will be allowed. Next and the last item possibly I'll take, country by country reporting. Now, what is this country by country reporting? If you look at transfer pricing amendments under that BEPS action plan, they have created a documentation rules, action 13. I did not speak purposely at that time. Now, action 13, and by the way, each country has notified what rules should they follow and what are they going to do on this. Most of the countries in the world have notified CBC. India has already notified last year. We have section 285 or something like that, BA or something. We have got country by country reporting in our country. What is this is trying to do? Country by country reporting is an action under which, if you are a multinational company, MNC, and you have presence in more than one country, you have to file certain basic information with the tax authorities in respect of your business which you are doing in this country, as well as in respect of the businesses which you are carrying out in various jurisdictions. You have to give information about your turnover. You have to give information, you have to file two documents, master file and local file. Where the company has a headquarter, you have to file master file in relation to information about your company and group as a whole. Transfer pricing documentation which we are doing, the study report which we are filing, that will be a local file here. So in relation to the local file, you have to file additional information in each of the jurisdiction as well as that local file in the head office. Now that document will consist of three things: your total turnover, each country's turnover, asset base in each country, employees in each country, profit in each country. Very simple. They say this is only a tool to identify risk profile of your group. We are not asking doing anything. We are not going to misuse that information. We will analyze this information, and based on that we will analyze. Our analysis will find out, are you a risk profile client? Are you doing business in the world wherein maximum profit is in the tax haven, where the least assets and least employees are there? And if that is the case, the transfer pricing officer will use that information for his advantage or for base judgment. He will issue notices to you. And therefore, friends, Instead of solving the problems of the world, you will have major problems coming in. It is not every businessman who is doing businesses across the countries will have to remodel their business structures appropriately. Of course, this country by country reporting will apply to any group having a turnover of more than 750 million euro. India has also followed the same standard. So if your turnover is beyond 5,000 crore, possibly this requirement will apply, group turnover, and then you will have to comply with this information. You will have to file such information with the tax authorities or home country. And if suppose you have a parent somewhere else and they have not yet adopted the country by country reporting standard, then the country where you are operating, you will have to file this information and you will have to obtain the information. At times it is not possible to obtain, but now it has been compelled to you that you must obtain. The revenue officers, based on this information submitted to the authorities, will exchange information with each other. Whether this, and they will obtain the information. Okay, in this country, this client is operating. Find out this, that, and give us the information. Similarly, we will give you the information. And therefore, in fact, European Union is on the record to say that we will make this information publicly known on the website. It means what businessman has to do. His whole strategy is of doing business. If Coca-Cola company is told to give your formula and put it on a website, I think tomorrow Coca-Cola will be stop selling anywhere in the world. That whole proprietary technology, their intellectual property is their formula. And therefore, if the businessman is told to reveal all the secrets, how you are doing business in such a... There are countries and countries where financial product... I was talking to MNC foreign equity, private equity investment vehicle. They say we have 2 employees handling $2 billion investment. 1 or 2 employees, more than enough. I say, how do you carry out research? Everything is outsourced. Why do you need to have a number of employees sitting at one place? And India considers, oh, you have 2 employees, there is no substance. Because we see huge number of employees, personnel. Jallikat, one problem in Tamil Nadu. Lakhs and lakhs of people on the street. We are not comfortable without seeing lakhs of people. So therefore, we believe our substance standard is lakhs of people. Whereas the world says we don't have people. The population of this country is more than the population of whole of Europe. Therefore, in such a situation, substance test varies in each country, and this is going to be a major area of problem in the future. And timeline for compliance with the CBCR has been laid down. By 2016, you will have to file first report with the authorities. That report will be submitted, and the first filing deadline for multinational companies will be 17. You will have to sign the report. 17 May you will have to file. Then transmission of the data will take place, and the competent authorities will review the situation within 6 months, and thereafter they will exchange the information. Likewise, second filing, third filing will go on. Now it is going to be a continuous process. We will have to timeline. You have to monitor and follow it carefully. I have said it earlier. We are going to have CFC in this budget. Till day before yesterday, I was greatly confident about it. When I read the poem circular yesterday, before interviewing on television, I said, what is there in the CFC now? Why should they get CFC in our country? What CFC is talking about, they have got in poem. You should not have a poem at all now, CFC in our country. And I would be surprised, still if they want to have CFC, despite the poem being so elaborate, what will be the CFC, God only knows. CFC is exactly what they are talking about the poem, the draft circular. What it envisages, if you are an Indian company and you have got a subsidiary abroad, and that subsidiary is hollow subsidiary without any substance, all the decisions of that subsidiary are taken by the directors in India. They do not have proper director, they are only nominee director, paper directors. All instructions are going from India. It means literally you are doing activities from India. All the activities, though it are substantial activities, active company, but it will be deemed to be passive company. All the transactions with your subsidiary are between the group companies only. Then it will be passive income. If your income is more than 50% passive income, then such companies will be regarded as poem in India. It means on those companies' profit, you will have to file return in India and pay the tax in India. Without corresponding tax credit in that country, God only knows whether this will be workable. This is one area where is going to be a major challenge, and all experts now will start debating and giving suggestions to the government, but the circular has already been issued. It is now for the next year whether the government changes the circular. Another area of concern possibly in this budget, you will see this thin capitalization rule. Thin capitalization is nothing but the debt equity ratio. If you are a foreign company investing into this country by way of an equity, understandable. But if you are investing into this company by way of a debt, Government of India want to now create rules. Possibly the debt equity ratio should be monitored. And also the expense of interest as compared to the other expenses also should be monitored, the American way. And therefore, the government is likely to create thin capitalization rules because that will be more specific anti-avoidance provisions rather than covered by the general anti-avoidance provision. We are one of the country which is regulated by our foreign exchange regulations through the Foreign Exchange Management Act. And we are not encouraging substantial loans or debts, NCDs from foreign source or the external commercial borrowings. We regulate it very clearly. So therefore, frankly speaking, if one regulation controls such provisions, what is the need of getting into thin capitalization rules in this country is an issue by itself. But we have played major role in that hybrid mismatch draft action plan 2. The India's role is there, and we have advocated thin capitalization rule also should apply. Multilateral convention, I have already spoken about it. General anti-avoidance rules are kicking in from 1st of April 2017. Now enjoy your life thereafter. Thank you very much for listening me patiently. I have done my best to complete the topics given to me within the time allotted. Thank you.
BCA is lucky not to have any US member, so we don't have to do any FATCA compliance. With regard to the passive and active income, quite possibly this budget will see the definition now coming into the Income Tax Act. Maybe and whether CFC is required or not, and to have a multiple regulation is also a question. Maybe after the draft rules in place, now final rules in place rather, CFC may not come, but let's hope for the, I won't say for the best, but some clarity on that. With this, there's no time more for any questions, so I request Divya, I think Mayur wants to speak something. Yeah, Divya, if you can.
You have been attending Palkhiwala's lectures during your this life. You are one of the lucky fellow. And Palkhiwala has always been saying, and he did not get tired repeating this statement. Institute of Chartered Accountants of India, of which Central Council member is sitting here, has kept their stooges in the CBDT so that amendments are made to the law. The two beneficiaries in India, one is Chartered Accountants community and the taxman. No, taxman, lawyer, baad mein. Thank you.
Good evening, everyone. A few announcements for the upcoming events at BCAS. We will have Shri Soli Dastoor speaking on the direct tax provision on the Finance Bill 2017 at the Yogi Sabha Gru Dadar at 6:15 p.m. on the 7th of February. Also, Advocate Shri Vikram Nankani will be speaking on the indirect tax provisions of the Finance Bill 2017 at the BCAS on the 9th of February. There will also be an expert chat on the internal audit, global trends and outlook which will be held on the 30th January at BCS. Also, you're also welcome to the CPR workshop and a medical camp organized by BCS and Asian Heart to be organized on 11th February. For more details of all the other events and these events, please log in into bcsonline.org. In today's world, transparency and substance is the key to international taxation, with of course its complexities and ways to get around it. And who better than speaker today could enlighten us about the evolutions in international tax? His transparent and lucid styles phenomenally clears our clouds of unawareness of the tweaked areas of these mighty and dynamic provisions. It truly was a joy to listen to Mr. Ostwal. We're thankful to Mr. Ostwal for his magic tricks when it comes to explaining the most complicated of the international tax issues so gracefully. Let us all cherish the knowledge imparted in today's lecture by Shri T.P. Ostwal and give him a round of applause. Thank you.